So there's two things I think about when I'm managing liquidity in a large institution. I think about the amount of liquidity I need to hold to meet my risk appetite, and that's what we call a management buffer. So potentially, as I have a large shock, liquidity could drain out the institution and I could breach my risk appetite. So I still have lots of liquidity in the bank, but I breach my risk appetite. And Neville, you might say, well, Josh, is that a big problem? You breached a limit. It's a big problem.
This is Liquidity Talks, a live stream and podcast series designed to share the latest trends and updates from the world of Treasury, liquidity and risk. Join us as we power up the liquidity conversation.
Hello and welcome to our latest installment of Liquidity Talks live stream and podcast. I'm Neville Roberts, CEO and founder of Planix, the market-leading fintech focused on real-time treasury, liquidity and risk. Now, our topic today is entitled Understanding Hidden Liquidity Risks in a Volatile Market. Welcome to our audience today. Good morning, afternoon and evening, wherever you may be. Anyone in the audience can ask a question as we run through the next half an hour. If you put it in the comment sections that you see on your screen on the right-hand side, I can take some of these as we go. And if there's any that are left or we have too many, we can ask them and answer them after the podcast as well. If you have a question, please let us know who you are and if you possibly can, your role, so we have some context. Also, anyone in the audience can join these podcasts and actually can be on the podcast. We've had a few audience members in the past be part of them. So if you'd like to be part of them in the future, just email either Nick Appleby or Adam Pemberton. And they're just about to put those emails in the comment section as they are. And we can make that happen. Now, today I'm joined by our guest speaker today, Josh Mickle. So Josh, welcome. Would you like to introduce yourself and tell us who you are and what you do?
Yeah, so Joshua Mickle, I've been working in the liquidity risk space for around 16 years across financial institutions and in consultancy. So key areas of focus: liquidity stress testing methodology, hence the meeting today, managing large liquidity projects, and liquidity governance framework, CFP, and so on. And Neville, I would say the subject that we're going to talk about today is definitely one of the more interesting areas of liquidity risk, but one of the more complex areas. Complex from both a conceptual point of view and an implementation point of view. So the risk straddles many different products within the bank. So definitely a holistic understanding of the products required. And then from an implementation point of view, typically we need to use systems outside of liquidity risk and treasury. And I think you probably got the experience to say using systems outside your area in a bank is quite challenging.
No, I agree. And I was just thinking then, if you've been in this game for 16 years or this space, you must have come in just at the right time when this all got exciting, right?
Yes, I just joined just after Lehman's went bust. When Treasury was unfortunately very interesting, but very small and had very few systems.
No, exactly. Exactly. And that you can probably work out from Josh's accent today, but you're up from the northeast of England. So I'm going to assume by that you're a Newcastle fan. Is that fair?
Assumption correct.
Now, I wasn't going to mention a lot of football because if it's a Newcastle fan, obviously there's a cup that you won a few weeks ago. But obviously, we're the only two teams in the whole of the Premier League to have won anything this year. So I think that's a good start to proceedings. Right. Two other things. One is we're going to put Josh's email in the comment section as well. So if you'd like to contact him after this event, then please feel free to do so. We're also going to post two really good LinkedIn articles, both written by Josh. One is about building a best-in-class liquidity framework, which is just, how do you go about building the framework you need from a liquidity and liquidity risk point of view. And one is on hidden liquidity risks in a tariff-driven market. So I've read that. It is really interesting because obviously tariffs are the big topic these days. And we don't know much about where they'll end up. We have some views, but there's some hidden liquidity risks in those tariffs and how they're moving around. So that's definitely worth a read. Right, so on to the topic of today. Let's get straight into things, Josh. Why, in your words, is market shock liquidity important?
So liquidity moves from market shocks can be very material. So materiality is definitely a key driver of its importance. And I'd also say, as you kind of alluded, it can often be a shock to management that are actually running these liquidity positions if they don't have the right frameworks in place to capture the risk. And Neville, if I just give you a couple of examples where I suppose it hasn't went so well in these shock environments. So Credit Suisse during COVID had material margin calls on its derivatives, which actually meant that it struggled to meet its risk appetite within that stress. Yeah. And that was cited by FINMA in their 2023 report on CS. So if the regulator is citing that as a problem, it's definitely a big problem. So that's an extremely large, or was an extremely large institution, which was effectively rocked by extreme market moves.
Yeah.
And then recently we had a FX broker dealer called Argentex, and there was an article in the FT around FX moves on US dollar, which effectively created margin calls, and they had to suspend their shares due to the inability to meet their liquidity requirements. So again, a good example recently where small institution probably hasn't modeled the liquidity risk for market moves, and unfortunately being caught out with serious consequences for its share price.
And what would you classify as a market shock? Because I was just thinking, like, do you know when these are coming? Can you predict them? Are they black swan events, so they're very hard to predict, or do you just have to have your eye on the market all the time?
So Neville, if I knew when they were coming, I'd be working in a hedge fund.
You'd be a rich man.
Like, the way we tackle it in liquidity risk and market risk to some degree is we pick historical scenarios, we stress maybe those scenarios as well, and then we apply them to the risk factors. So we have a concept of what could happen, and effectively we then risk manage against that possibility. And if you don't do that, then effectively you've just got an open risk position with no kind of hedge on top.
Got it. So it's not just, is it a market shock or not? It's a spectrum of the risk that comes from it, and we could have, unparalleled shocks, but they probably happen. It's like earthquakes, right? They happen probably all the time. It's just the size of them that actually counts in the end, I guess.
Yeah, that's right. And obviously the risk exposure the bank's running from a liquidity perspective.
Got it. So in terms of implications of this, what are the implications of liquidity impact if those shocks are negative?
So there's two things I think about when I'm managing liquidity in a large institution. I think about the amount of liquidity I need to hold to meet my risk appetite, and that's what we call a management buffer. So potentially, as I have a large shock, liquidity could drain out the institution and I could breach my risk appetite. So I still have lots of liquidity in the bank, but I breach my risk appetite. And Neville, you might say, well, Josh, is that a big problem? You breached a limit. It's a big problem. Yeah. So if, for example, you breach your LCR, you still got lots of liquidity. You might be at 99, but it's a very difficult conversation with your regulator of how you didn't foresee this and you didn't hold an adequate buffer. And that's the same internally with management within the bank. Very, very difficult conversation if you breach a limit over a risk appetite. So that's one example. And then you can get a more extreme example, which was, I suppose, the FX broker dealer I mentioned earlier, where potentially you just don't have enough liquidity to meet your margin calls. Then you're in a potential insolvency event, which again, far from ideal.
Yeah, I think regulators used to come in. They asked asked a standard set of questions, but these guys, they're moving beyond that. They're asking questions about how do you handle market shocks, what kind of risk appetite does a bank have, and how can you prove to me that in the moment that it happens, you have the insight and you also have the controls to be able to manage it. And it's a much more complex question now, I think.
That's exactly right.
Yeah. Good. So I'd often hear a few things around, and it'd be good to actually get your view on them and dispel whether or not these are misunderstandings or they're actually true. But one is, with market risk hedged, I've got no liquidity risk. I've heard that many times. And also, it's not to worry. This is just purely an investment bank problem. They don't sound like they should be true, but what's your view on them?
So on the market risk, so yes, you can be market risk hedged, but you're definitely not liquidity hedged. So let me give you a few examples. If I've got a collateralized derivative versus an uncollateralized derivative, which is often the case, we might be facing off against a central counterparty, and then we might be facing off against a corporate who maybe we don't collateralize. In that case, we're market risk hedged, but when the derivatives change in value, we'll either post or receive collateral. So that would be a liquidity inflow outflow. So that's an example where you hedge, but you're not hedged from a liquidity perspective. And then second example I'll give you, say you hold a stock and say you hold it in the box. So when I talk about hold it in the box, I mean it's repoed out, and you hedge your Delta 1 TRS. So again, you're fully hedged from a market risk perspective, but from a liquidity perspective, you'll post collateral or receive collateral on the derivative, but nothing on the stock. Now, if the next day I'm the trader and I decide to repo out the stock, I'm then liquidity and market risk hedged. So you can see your risk exposure in a bank can be very dynamic. Your risk position hasn't changed. All you've done is repoed out your security, and you've gone from being unhedged liquidity to hedged liquidity. So it's quite a fluid risk exposure as you go through time within the bank.
No, I get it. And also, it's not just banks, it's not just investment banks, it's banks, but it's also more and more so non-bank financial institutions as well. There's a thought going around, it's been there for at least a year or two, that the next problem is going to be with non-bank financial institutions. Banks are a lot better than they were, but non-bank financial institutions need to work on this. Is that your view as well?
Yeah, it's a really good point. So insurance companies, if we remember the Liz Truss gilt stress, they had large margin calls on the derivatives, and then there were fire sales and to meet the margin calls. So that definitely tells me that they don't have a liquidity risk expert, and he hasn't modeled those types of scenarios. So I think it's really good to say that this isn't just a bank problem. It's any institution where they have these kind of margin arrangements. You can have this type of liquidity stress.
Yeah, we're also starting to hear from some of the larger corporates as well.
Okay.
And I think it's more about, it's not necessarily obviously about regulations, less so about risk. It's literally just, where's my cash? How do I optimize it, and where should it be? And for the small and medium to small size corporates, that's not that important, but for the very largest, it is. So we're starting to hear some of those thoughts from corporates as well. Okay, so look, now we're starting to understand the picture of the risk. Ultimately, the question that comes is, how do you mitigate that risk? What tools, techniques, frameworks? How do you do that?
And before I go on to that, I'll just cover off your question on the non-IB banks.
Yes.
So in a retail type of bank, you'll hedge your income on your deposits with interest rate swaps. So LBB, effectively management. So again, in retail banks and in universal banks, that exposure can be very material, if not one of the biggest exposures in the bank. So as those derivatives move in value from rate movements, again, you can have very large collateral inflow outflows with no offsetting flow on the deposits.
Got it.
So it's definitely not just an IB problem.
Yeah. Okay, so good. And moving on to mitigation of the risk, the approaches. How do you think about that?
So mitigation,
you must get asked a lot in your line of work, right?
Yeah, definitely. So mitigation, I think you always need to fall back to a robust framework, and I think you talked about the article I've written on framework. And some of the key components of the framework are risk identification, risk quantification, and risk appetite. So risk identification, identifying there is a risk. So often this is a surprise to management and people within the bank that we're actually running this risk. And once you identify it as a risk, then try and quantify it. So we talked about applying historical scenarios to try and quantify it, and then apply risk appetite to it. And in a bank, applying a risk appetite effectively means holding a liquidity buffer and a management buffer against that risk. So when the risk crystallizes, you have enough liquidity to meet the collateral requirements.
Got it. Understand. Okay. We've got a question come in. It's from Dan Feeney, and Dan was actually on our podcast last month. What is cash anymore with the stable coin mania? Not sure if that's a question or a statement, but I know in my local pub, once they start taking stable coin, we really truly be done. But any comment on that, Josh?
Well, I think you'll find the big banks stable coins haven't been rolled out yet. I know. I think Fidelity's looking at kind of rolling it out. I think it's very early stages. I think, and if you think about CSAs, nobody's updating the CSAs to take stable coins. in the short term. So I think you'll need to see a big shift in the industry before that becomes kind of relevant. Maybe smaller institutions, but I see that as somewhere down the line.
Yeah, no, I get it. All right. So what about risks from market shocks? I mean, how do you think about them, approach them? Is it something a bank would say, look, it happens, we've just got to deal with that at the time? Or is there frameworks you can put in place and, scenario planning that you should do it in advance to mitigate those risks?
So when I think about risks, I think we touched on margin. So definitely margin postings, definitely a key risk. And there's obviously some nuances in that, which we'll come back to. Even when you don't have an instrument which is margins, it can be problematic. So if I have, I don't know, $1 billion of US Treasuries within my liquidity pool, if I assume I'm going to sell them, if the price of the Treasury falls, which we didn't think would be a problem until the Trump scenario, that's definitely less liquidity than you expected. So you think you've got $1 billion of liquidity, and then you've only got $500 million of liquidity. So that kind of concept of I'm assuming I'm going to sell it, or I do sell it, and I don't get the value I thought I was going to get, is definitely an issue. And then also where we have trades where they're maturing in the stress period, so uncollateralized derivatives, if they change in value, so maybe you've got a PV of 100 a day, the stress happens and you've got a PV of 200, and then before you know it, you've got larger outflows than you anticipated. So in summary, it's assets sold, it's transactions with margin, and then it's transactions which are maturing over the periods where the value is determined by market parameters.
Got it. We've just got another question in here coming from Christina Freigstad. What's your view on the PRA HLBA for derivative margin requirements?
I've got to be honest, I'm not an expert in that area. I'm more focused on what's been agreed and then model that from liquidity in terms of their margin requirements. I wouldn't say I was the expert to talk about that, Neville, so happy to defer to you, or maybe
no, it's fine. What I suggest, Christina, we will have people who will have a view on that. Why don't we put that in the LinkedIn afterwards and answer that question then? I'm not an expert in that space either, so I think I'll leave it to someone who is. But thanks for the question, Christina. So look, the next logical question in terms of risk is, how do I quantify the risk? How do I work out what it is and put that against how the approach I do to mitigate it?
So the first thing you do is you need to pick a scenario. So you need to pick a scenario where we have movements in market parameters, equities, rates, credit spread, volatility, the full suite of market parameters. And how do you pick that scenario? So the main regulators will talk about plausible but severe scenarios, probably for skew on severe versus plausibility. And when we think about that, when we work in a bank, typically we'll think about 2008, COVID, and probably the Trump stress as potentially plausible scenarios. So we have to get that parameterization is kind of step one. And you might actually iterate through that. So when you actually apply that parameterization to your risk exposure, you may, for example, find that you've got an inflow. So for example, there's a lot of banks who may be hedging against interest rate falls. Typically, like in COVID, rates came down rapidly, and that would give you a liquidity inflow on your IRBB hedges. So definitely you wouldn't want to have a inflow when you're trying to model the severe. So you might cap that at 0, or you might actually change the assumptions on interest rates. So generally you want to have an outflow, and it wants to be based on a kind of severe event. So that's kind of step one in terms of the process of quantifying.
Got it. Got a lot of questions coming here, Josh, by the way.
Okay.
Let me pick on another one. Eldrin Pereira, how do you approach liquidity risk monitoring, and what tools or technology you find most effective? I can certainly answer that one, but I'm going to let you answer. And maybe we also have a view on collateral as well, because it's not just cash. Do you have a view?
Yeah, so intraday liquidity modeling, and not to kind of quote the regulator, but I think the ECB came out, or the EBA came out recently with kind of best practice. So, things like real-time monitoring, so understanding your position, having the ability to throttle your payments used to be a nice to have, now is a must have. Having escalation, so not waiting until you failed before you escalate. Having the risk function part of that review process is very important. And then from a stress testing perspective, again, looking at your historical BAU usage I think the EBA talk about a 95th percentile of your BAU as a kind of backstop. From a stress testing perspective, typically we assume things like loss of aggregate shortline and CLS, reductions in and out swaps, 1 hour delay in payments, reduction of transactions which wouldn't occur in a straight issuance, loss of corresponding banking lines. I mean, to be honest, Neville, we could have a whole session just on how to model intraday liquidity. But in essence, I think they're the key things that I would think about.
Yeah, and I think, if you look back to where we were I started to get into the space about 2012, without the right technology and tools, and obviously we'd say in real time, you haven't got any chance at all. Even if you're a small bank, it's just too hard. You need to have the right technology. It needs to be appropriate enough, so there's no point just having it end of day. It needs to be there, and you need to get your insights during the day. So we would add that to it as well. A question here from Daniel Eparu. Now it's on shadow banking, and as Adam said in the comments as well, we did have a podcast on that with Murad Chowdhury a few months ago. There's a link in the comments section. Josh, don't know if you have any comments about shadow banking. There's a whole podcast on it, but if you've got any comments, then that's fine. But we'll also leave it to the podcast.
Yeah, I mean, I think in the context of this discussion, the example of the FX broker-dealer, these frameworks and liquidity modeling is definitely applicable to hedge funds, to broker-dealers, just as much as it's applicable to a bank. They have margin calls, they have potentially liquidity pools, those change in value in market stresses. And I suppose for a hedge fund, if you're forced to close out your positions, a bit like the insurance companies where you've got a fire sale, it can be an extremely kind of unsettling event and very P&L negative. So I would say equally, if not more important for small shadow banks, where if I work for a GSIFI, I've got a lot of diversification level. So I've got a massive retail business, a massive corporate deposit business. And sometimes these movements get lost in the noise. But if you're on a broker dealer and you've just got derivatives, or you're in a hedge fund, you've got a big derivative on, there's no noise to get lost in. You're going to get burnt if you get a large collateral call and you don't have liquidity.
Yeah, no, I get it. Okay. So look, bearing in mind the quantification of risk, how we mitigate risk and the approach to that, what instruments and transactions should we apply to this scenario?
So let's start with I suppose, the easiest one to understand. So assets we're assuming to sell, so our liquidity pool and also management actions. So typically in a large bank, we'll assume that we'll sell down some of the IB trading inventory. So the valuation of those asset sales should be at a stress price versus current spot price. So that's kind of step one to understand kind of impact. Don't just take the spot price of your liquidity pool or your equities you've got in your IB. You need to stress to a volatile market. So let's start with the easy one. Yeah. Then moving on to collateralized derivatives. So we have the actual derivative risk exposure, and that's what we think about from a market risk perspective. So we need to revalue the derivative, and that revaluation of the derivative will drive a collateral call or posting. But on top of that, we need to revalue the collateral that has already been posted or received. So that element of collateral, we may or may not be on market risk, but as the collateral changes in value, it can create an additional inflow or outflow. So if I post equities as collateral under a interest rate derivative and those equities fall in value, then I've got to post more collateral to meet the requirements. So the combination of those two will tell you effectively your gross collateral inflow and outflow. But unfortunately, you need another step on top of that. So all CSAs aren't the same. So we have things like one-way CSAs. We have CSAs where we don't have repo rights on the collateral. And we have CSAs where collateral can be posted, which is less liquid. So if we have, for example, less liquid collateral and we can't on-post the collateral, then from a liquidity perspective, even though we've received the collateral, it gives us no liquidity benefit. Exactly. So it's a kind of two-step process of calculating the collateral that you think you're going to have to post to receive, then effectively accounting for the liquidity benefit depending on the CSA. So that's one element. And you can see, Neville, one of the points I made earlier about the complexity. In liquidity risk and Treasury, we don't have a system which revalues derivatives. So typically we need to source that kind of data in around how the derivatives would change in value and the collateral would change in value. And then on a similar type of concept, but a different product, SFT. So where we have secured positions, whether that's repos, reverse repos, collateral swaps, PB business, cash PP business, all those transactions and instruments are based on a margin concept. So as the collateral changes under an SFT, then we either post or receive more collateral. So again, we need to model the market risk on that SFT and the change in the value of that collateral posted to calculate the potential liquidity, and then also take into account what collateral we're going to receive, whether it's a liquid or liquid. So again, a relatively complicated process, which in this case doesn't really kind of align with market risk, because we're revaluing things where often we won't have a market risk on that position.
Got it.
Third point, I'd say uncollateralized derivatives. So uncollateralized derivatives, you only really see the liquidity impact on maturity. So you need to revalue the derivative to estimate the value at maturity, and then you'd have that outflow or inflow from the derivative. So again, revaluation process, looking at the maturity value. Moving on to a subject which I know is close to your heart, Neville, intraday. So if I post collateral at the central bank to meet my intraday clearing requirements, if that collateral reduces in value, then potentially I've got to post more collateral to meet those intraday requirements. So I'm not selling the collateral, I'm just using the collateral for intraday. So I need to take that into account within my stress testing. And then finally, the point which most people find not very intuitive. Normally when I finish all my stress test calculations, I have inflows in currency and outflows in currency. So let's take a simple example. I've got inflows in dollars and outflows in sterling. And I normally translate them to a base currency. If I'm a UK bank, I'll report those in sterling. And I translate that normally at the spot rate as of today. But really, I should translate that as it is stressed FX rate, because that would be the rate I'd have to swap the currency flows to kind of offset each other. So you definitely need to use the stressed FX rate to effectively translate your stress results into a base currency.
Got it. Great answer there. So we've got a lot of questions coming in. I think what we're going to have to do, there's some more from Dan, also from Richard Wilshire as well. So I think what we're going to have to do in the interest of time is to probably answer them afterwards. I know Nick Appleby's helping on the comments as well. When you're talking about stress testing, can stress testing liquidity really be standardized? Is it bespoke to the institution? You have to think of it that way, or do you think there's a standard way to assess it?
So I think the framework is standard: risk identification, risk quantification, risk appetite, and so on. That's a standard approach I would recommend all institutions follow. In terms of the actual calibration, so we touched on scenarios. If I use 2008 and I have a liquidity inflow, I'd probably need to calibrate that specifically for the institution. So I think a lot can be standardized, but you need to tailor the scenario. And obviously all the aspects I've talked about today may not be applicable for every institution. So you just kind of de-scope some of the risk exposures. But the framework itself, I think I would standardize that across different banks and different institutions.
Got it. And a favorite of mine around AI, because there's been some questions come in on that as well. Is AI starting to play a big part in this in terms of forecasting, accuracy of liquidity? Is it starting to play a part in the technology that's being applied? Are you starting to see that, Josh?
Yeah, I think AI is in terms of BU kind of volatility. So I don't know, change in rates. Do we have more deposits? End of the month, we make payroll and deposits go out the door. So I think for the BU type of volatility, definitely. I think for this more tail risk, I think it's more difficult to do. I mean, I'm not sure I've got the stats, but I think the Trump event was like, I don't know, 1 in a million event. So probably the AI would probably tell you don't hold liquidity against it. Or maybe wouldn't anticipate it at all. So I think certain things I suspect are quite hard to model using AI, but the kind of run-of-the-mill, do we have payroll out on the 27th, deposits dip into people and so on? I think, that's definitely, banks are definitely looking at that.
Yeah, and you think about all these events that are 1 in a million, but they're tending to happen more often now, or perhaps we just notice they're happening more often now. So great. Well, look, we're almost out of time, but we always tend to end with this question, Josh. So if you've got one key takeaway for our viewers and listeners today, what would it be?
Maybe I can give you 1.5. One is have a robust liquidity framework.
Yeah.
Very important. That generically captures the risks of liquidity and responds to them. So that's one point. And I would say don't underestimate the impact of market moves. And you won't do that if you have a strong liquidity framework.
Exactly. I'm going to count that as one, but thank you for that. Look, unfortunately, we have run out of time today, Josh. So thank you very, very much for joining us today and sharing your thoughts and views. If anyone asks questions after the event, and we've got some that we want to respond to after as well, then we'll do that for you. So that concludes our latest Liquidity Talks live stream and podcast. We'll put the podcast on LinkedIn, Spotify, Apple Music, and other media outlets and streaming services very soon. Thank you very much. Look out for our next podcast, which is on the 5th of June. My name is Neville Roberts. Thank you for tuning in, and goodbye.
You've been listening to Liquidity Talks. Don't forget to subscribe to stay updated on the latest developments and industry opinion from the world of Treasury, liquidity and risk.